But oil prices are ticking higher this morning as concerns rise over conflict spreading in the Middle East. Joining us now to discuss Citi Global Head of Commodities, Ed Morse. Ed, it's good to have you with us. Though we are ticking higher on WTI and Brent this morning, although still kind of within this range, a little bit off the highs of a couple of weeks ago. What's your read right now on the interplay of what you consider a relatively weak product demand and then that geopolitical premium?
So the geopolitical premium is certainly there. If you look at 30-day volatility, the volatility kind of increases when you come to the weekend because nobody wants to be positioned in a way that whatever happens in the weekend might affect them. But the physical oil market is really a lot weaker than where the price is printing at the moment. People have been exaggerating the oil market immediate implications of whatever might happen. It looks like nothing might happen in the immediate future that's going to affect prices. So fundamentals are there, and we're seeing them in spreads, prompt spreads to second month. They haven't collapsed, but they've come in by a good 50%, which is a sign that the physical market is pointing in a different direction from the volatility, but we're still a good $10 below where the peaks were last month.
The physical market, showing a bit of softness on the demand side. Is that inconsistent with the overall economic numbers that we're getting, whether it's on consumer spending or other metrics?
It is, and it isn't inconsistent. So certainly it's inconsistent in the sense that you'd expect with a higher GDP, if we're in fact seeing that, there would be higher demand for commodities. But there are structural changes at work as well. We have a lot of noise that happened because of the pandemic. We had a recovery from the very lows of the pandemic that make whatever you think is steady state in terms of GDP and its relationship to oil demand growth a little bit more obscure. But I think the fact of the matter is that the structural changes are overwhelming. We are down year on year in overall product demand in the United States, which is kind of the strongest of the large economies in the world, the ones seeing the most substantial growth. We're down in Europe, we're up in China, but that's the effects of last year and the shutting in of so much industrial and transportation activity. Demand is really on a weaker path in terms of its relationship to GDP, and we expect that to continue. Transport fuel demand, in particular, doesn't look as robust as you'd think it would be in a growing economy. We think China has peaked in diesel demand, is about to peak if it hasn't already in gasoline demand. Europe has done the same kind of peaking. That's 2 out of the 3 largest economies in the world. And you look at year on year, U.S. gasoline demand, year to date, it's down year on year. So it's a pretty remarkable structural change that's at work as well.